the United States is experiencing its longest government shutdown in history, and that's created an unprecedented blackout in economic data. Key reports from the Federal Reserve covering jobs, spending, investment, and inflation have been delayed, and it's now likely that the entire set of October data will be missing. Even so, policymakers and market participants are completely in the dark, as a patchwork of private sector and state-level data have continued to offer partial insights into the economy. So what do we know about the jobs market without official data? Overall, the labour market looks stagnant. Job growth has slowed sharply since spring, raising concerns that the momentum in hiring is fading. The latest ADP data showed private sector employment rising by just 42,000 in October, a modest rebound after September's drop of 29,000. That's at least a sign that conditions haven't worsened further, but it's still far from strong growth. So another measure, the non-farm employment replacement index from Revelio Labs, estimates that a loss of around 9,000 jobs in October. So this figure is limited in scope, focusing mainly on office-based roles, but it doesn't fully capture the broader shifts in the economy. Still, other surveys echo the same story. Companies are hesitant to hire and business confidence remains fragile. Turning to energy markets. So light crude oil futures extended their decline last week, with December contracts closing at about $59.75 a barrel, down just over 2%. The drop was driven by several negative forces working together. So a sharp increase in US inventories, record high domestic production, and signs of slowing global demand. These factors completely outweigh the support from OPEC production cuts or a brief rebound in Chinese imports. On the supply side, US commercial crude inventories jumped by more than 5 million barrels in just 1 week, reaching over 421 million barrels. Production is holding near a record of 13.8 million barrels per day, while lower refinery activity is adding to the buildup. Meanwhile, Saudi Arabia's decision not to cut its official selling prices for Asia reflected a clear acknowledgement that the weaker demand in the region is increasing. Global consumption is softening, gasoline use and shipping activity in the US are both down, Japanese manufacturing PMIs have fallen to an 18-month low, and JP Morgan has trimmed its forecast for global oil demand to just 850,000 barrels per day. All of this reinforces the sense that supply pressures are outweighing demand and optimism. Finally, looking at gold prices, as they've been consolidating around the 4,000 per ounce level, fluctuating between 3,950 and 4,060 over the past week. Analysts describe this as a pause within a broader uptrend, as gold has already risen more than 48% this year. Supported by the safe haven buying and strong central bank demand amid geopolitical uncertainty, but for the next leg higher, the market is waiting for a fresh catalyst, stronger economic data or renewed global tensions. Many analysts remain cautiously optimistic, with FP Markets' Aaron Hill calling the current range a healthy consolidation that could pave the way for a push towards the 4,200 level.